Welcome to another members update. It's October the 16th on Sunday, and it's 14th on the Friday is the closing I'm looking at. The situation, as I mentioned in the overall market overview, which you should look at before this always, is definitely getting more and more bearish. And I'm seeing more evidence of this all over the place in different ways. And as I've been indicating in recent weeks, that time is getting close now, where I'm going to deploy a third of my position allocated to short this overall market, because I think this is it's finally getting there. This is the end, the New York Composite on the daily chart here. The last 2 days of trading action says it all. You know, it dropped below support, and then the buyers came in, and then on Friday it tried to go up, and then the sellers came in, and it closed exactly the same way. The amount of distribution days now is very elevated. Not only that, but you can just a cursory glance at the bottom here, and you see all those. Anytime you see a red bar sticking up compared to the day before, that means that's a distribution day. And they're concentrated now over the past 4 weeks. You'll be able to count. Well, let's do it. There's so it's compared to the day before, there's a red bar that's higher, and that's really all you're looking at. 1, 2, 3, 4, 5, 6 distribution days in the last 4 weeks. That's a high amount. This is a descending wedge now. I don't, the pictures, I think it's just limping through to get to the other side of the selection, but there's definitely nerves around now. So I'm not going to be doing any more longs. I'm not going to do any more short individual stocks either, because the picture still is a bit unclear. This is definitely, it was the case where the short term was up, but the overall market was piggish. But the short term and long term for now is all just uncertain. Having said that, though, I think longer term, definitely this is no doubt still a bear market. It's just holding in there for now until the election's out of the way. So now, caution note. I mean, I this is what I'm doing, and it's only a third, and this isn't. The chart is not giving me the green light just yet, but I want to have something out there. The market could go higher from here, but at least I'm going to have something in the game should it happen quickly, which it might. So I can spread bet with that. And as I've mentioned before, what I'm going to use is a triple short called SPXS, which is 3 times short the S&P 500. And it's currently trading down there around 1281. The good thing about that is that there's only 1,300 points or so to be lost in theory. So plenty of upside there. You can see what happened to this during Brexit there. It jumped up. This bear market isn't going to happen all in one go. There's going to be a series of probably 3 big down legs, and this may stretch out over 18 months. So there's going to be plenty of bites at the cherry if you miss the first one and you want to be safer. The safer way is just take a seat on the sidelines and wait for that first big bear market rally to come in, to be honest. So the other thing I could do is take an option out. The good thing about options is, unlike spread betting, is there's a finite amount I can lose. And the SPXS, current for January, an expiration date of January 2018, which is obviously a huge time in the future. That's available. The spread is a little bit wide on that. I will tell you, but that narrows down the closer you get to it. If you want a tighter spread and still have some leverage, the SDS, which is 2 times short the S&P 500, is giving you a better spread on options now, but obviously not as much risk-reward ratio, but still a good one. So they're the vehicles I'm looking at. Spread betting or options, either one, because they both give me leverage, and a third of my position I'll be looking to get that in this week, assuming that we don't suddenly see the market pop up above that wedge. But I think the prices aren't changing much now. You can look at SPXS. Is it going to get cheaper coming up? I don't. Not really. It's starting to hold its ground above the 50-day line now as well. So but it's still well below its 200-day. But the picture is getting more and more bearish, and I'm definitely jumping the gun a bit here now, as a caution again. So that's shorting the overall market. The Make My Millionaire trades, because of reasons I've just described, there's no Make My Millionaire trades right now other than the first two that's already been done, because to get that one right, all the ducks have got to be in a row. And right now, as I've explained, the market is still sorting itself out. It's frustrating, I know, but I'm not going to put stocks out for anything, actually, if I don't believe there's a high chance of winning. And cash is a position, as I've explained. The other thing I'm starting to notice is that I'm getting some stops going off, in which case, which is delivering a profit, because it's locking in profits, or it's getting a slight loss. But either way, when a good trading system, a reliable one like the one I use, starts to either your existing positions that are in profit start to hit stops, or any position for that matter starts to hit stops, that is the advantage of being strict with the trading system, is that you are already getting your warning signs now you're automatically bailing out of the market. Yes, all that's happening is your stops going off and you're just following it religiously. But what is often the case is when that's happening is that, look, what's going on there means that the market is about to take a dive. So just always obey the stops, and you'll find that automatically you're magically in cash when the worst happens, or the best happens in the case of you shorting it. So I'll touch on a few though, because last week I mentioned a couple if you're interested, and I did say that these are just being toyed with. If you wanted something to do, and I explained this one was NDAQ, and it's bounced down. And I said this was the kind of area to get in on it. So whether you did or not, I was quite pleased the way this bounced, especially when the market didn't do that well on Friday. I was on higher volume here. So that one's actually looking pretty good. That was a good entry point there at around 65, 66, and still is. So that's definitely made a turnaround there. And depending on the overall market, which is why I don't really like things right now, that should get a bit more of a bounce out of it. And AFL was the other one. And I said support was around 71. And it's during the week it kind of did get below that. So depending on what your stop was, what an entry point was, you could have entered that one with a stop I said of around 70. It didn't close at 70, so that would have still kept you in the game. And this one still looks okay. Support is still in there around 71. It's hung on to it, but as I say, tight stop there at 70. Looking for that one to bounce up. The gold picture, as I explained last time, nothing really much has changed, except gold is struggling to get above its 200-day moving average there, which is not a good sign. Also, the gold miners, that one needs to stay above 2250, and it's just about like gold, the metal, hanging on to its 200-day there. So I'm not in that gold or gold miners. They need to, well, not as a trade anyway. As I've explained last week's video with the difference between investing and trading. I'm talking about trading. Investment wise, I think this is still a bull market for gold. Trading wise, there's no pattern that's making itself clear enough just yet. A few of the miners individually though have carved out, like Newmont Mining for example. That's actually quite a tidy little pattern there, right above the 200-day. So there are some individual cases like the ones I'm showing you now. Actually, they're reasonably tradable though. To be fair, and ABX was another one there, but that was actually sorting itself below the 200-day, which I don't like. So it's not an ideal picture right now until the market gets its head around the idea that an interest rate rise in December, which will happen. It's going to be a gesture, and it's the interest rates will still be low. The world economy will still be in debt. The world economy debt is now over 200 trillion, and it's estimated that the economy isn't even worth that. It's not even worth half of that. It's a very, very dire situation moving forward. I can't emphasize that enough. and you need to be prepared. Yes, we're on the verge of what I think could be another, pretty bad financial crisis. And as I've explained in the seminar last summer, that's it for this week, and more next time, and speak to you then.